Well, good day, everyone, and welcome here from a scorching hot afternoon in London. And I'm delighted to have a dear friend, Emmanuel Antmann, dialing in today from Paris. And we're here to talk about the European merger and acquisition landscape. And Emmanuel's going to talk to us about some surprising shots in the arm for this market from COVID-19. Now, you'll know me, I'm Michael Mainelli. I'm one of the directors of Zien. And it really is a privilege to be able to introduce so many of these fun and fascinating webinars. And I can only do so because our sponsors are extremely kind and generous and allow us to range quite widely and freely across technology, economics, and finance. And today is very clearly in that space. Emmanuel is a dear friend of many years who spent quite a bit of time in the M&A market here in London, as well as in Paris, and has quite an unparalleled view of the European market, but particularly an overview of technology firms, which I know will be of great interest to our sponsors, as well as to those of you who kindly dialed in today. I'm anticipating quite a few questions and comments because it has been a surprising landscape. At the beginning of the crisis, pandemic, in March 26th, 2019, what am I saying? 2020. Everything was doom, and gloom. And I think Emmanuel's got some interesting facts to share with us, which will change all of our perceptions. Anyway, the format is quite familiar to those of you who dial into these. I will get out of your way as quickly as possible so you can hear from our expert. Emmanuel will be presenting for about 20 minutes or so, and then we'll move into questions and comments. And a few things, if I might. Firstly, the slides are already available and up on the website and in the chat room, so if you need to go back or follow them, they're there for you already. Secondly, there is a recording, and this recording will be going up in approximately 2 working days, i.e. about Thursday afternoon, for you to share with friends, colleagues, or rewatch. And finally, I am here with you, and the way that we're going to be handling the Q&A is if you could please type those questions into the GoToWebinar question and answer facility. I'll feed them into a conversation with Emmanuel. Emmanuel will be getting all of your comments and questions with your email attached. So if you have something you'd like him to follow up on or whatever, just stick it in the chat room and he will get it. May I point out that I am here with you. So Signal, WhatsApp, messaging, emails, I'll get them all afterwards, but they won't be of much use to the conversation. So please do stick them into that chat room. And with therefore no more ado, Emmanuel, the floor is very much yours. Welcome.
Yeah, thank you very much, Michael, for this introduction. Just a few words. Shortly before Michael and I had a discussion earlier this year for me to be present at one of these webinars, I had just read a press article describing how good 2020 had been and how much better 2021 would be. But however, to be fair, exactly a year before, as lockdown as the virus did, the mood was indeed very gloomy. And I, for once I realized I was not going to die of COVID, I really thought, that's it. I'll have to find another job in another industry pretty soon. So I thought it would be really interesting to look at what happened in that very, very bizarre market and sort of spice it up with a number of observations of what we actually saw at FDC during 2020. Michael?
Yes.
Yep. So next slide. So basically, very briefly, so I had the infrastructure and maritime franchise at FDC, where we do M&A, financing, advisory work across Europe. There are about 30 of us. And virtually most of our business is with European firms or international firms investing in that market. So going on to page 3, so we can actually wonder if anything actually happened in the European M&A market. So very briefly, so you see 3 years, 2018, 19, and 20. 18 is a bit off the mark because it was an extremely good year in Europe with a number of large mega transactions. But then if we compare 19 and 20, we see that those years are actually pretty similar in terms of number of transactions. In deal size, number of deals in 2020 is actually lower, but the deal size, that's approximately the same, suggesting that less transaction led to bigger deals. what this doesn't show is that actually in April and May, those were the 23-year low in the M&A market in Europe. And December was the best month almost ever in the M&A market. So actually what happened is that indeed, for a number of months, the market cratered and then picked up pretty strongly. But if we move into page 4, we looked at how the year unfolded, and we can actually see 3 periods. So looking at what happened on a month-by-month basis, we can see that in the first month, even almost to the end of March, even as China was closing down and a number of European markets were closing down, the market actually held up pretty well. It's only during April and until August that the market actually stopped literally completely. We think that it actually stopped only completely in 3 of those 4 or 5 months, in April and May, but then in August. And what we don't see here is that in June and July, the market was actually pretty active just before summer, but it's actually hidden by the fact that the previous month in 2019 were actually extremely high. And then from September onwards, what we see is that actually the market really picked up and the number of transactions grew up, as did the deal size as well. So we were actually really busy. Did all markets react the same way? So, Michael, I think I've got a few questions here.
You do, Emmanuel. I've got a poll here for the audience. Which European M&A markets do you think reacted most to COVID-19? France, Germany, Italy, Sweden, or the UK? So the poll's out there for you to answer. Emmanuel, we're collecting responses now. 30% of the audience have voted, over 50%, over 65%, getting there. I'll leave it open for just a few more seconds because we've got a couple more polls coming up as well. But with almost all the audience voting, I'm going to close that and share the results with you. So the audience believes overwhelmingly, maybe we're quite self-centered here at FS Club, 46% believe the market that reacted most to COVID-19 was the United Kingdom.
Okay, so I think next page will give us some answers to that. It did indeed, but not dramatically. And what we see that all markets were affected in Q2 of 2020. What is interesting though is maybe to take 2 examples. One is Italy and the other one is Sweden, because they both had very different ways of tackling COVID. Italy was the first European market to lock down, whereas Sweden actually didn't actually lock its economy down. And what we see is that so Italy is the green dotted line. They had a very good year up to Q4 19, and then indeed they dropped. And what we see that then the market has then picked up quite dramatically. And Sweden actually had a low end to 2019, so that's the red dotted line. And it was indeed amongst the market we analyzed, the least affected by COVID. And we can actually think that, or we can suspect that the fact that the economy wasn't closed down in that particular market explains also why the M&A activity remains fairly buoyant. And then Sweden, as Italy, had a tremendous end of the year, and they're the 2 markets which were the most active in Europe. So if we now look at 2 questions which actually were very present in our minds in 2020, has COVID brought any changes to the structure of the M&A market? And two angles to that question. The first one is, do PE investors, private equity investors, benefit from their billions in dry powder, or by European buyer took advantage of the situation by swallowing up European companies? And what we see is actually nothing actually changed really. So moving on to page 6, Michael. So what we see, and here is the financial investors share in the market. Across the 4 markets we decided to analyze, France, Germany, the UK, and Italy, this share hasn't changed in the course of the past 3 years. About 30% in France, about 20% in Germany, about 25% in the United Kingdom, maybe slightly rising, but like you have to look very closely. And Italy, about 30%, again, maybe slightly rising, but it's certainly not anything to do with COVID. Maybe 2 interesting points. If you look at not the curves, but the histogram behind the curves, you will see that France has been particularly dramatically affected in, it's April and May, with the market affected. And this is probably due to the fact that literally the French president asked the economy to close down completely and everyone was sent home. And then August also was a pretty poor month. And well, but this is quite typical of France actually, where August is always a lockdown month. Germany hasn't been affected, and again, their response to the COVID has been very different. First, it was a regional response; it was not a national response, and very broad. And what we also saw is that the number of COVID cases in Germany remained pretty limited, at least in the first wave compared to France. And this also might be a reason why the M&A market was much less affected. And when we see that the UK indeed in April and May was particularly highly also infected by COVID freeze, even though the lockdown only took place much later. So it's not entirely due to government action that the market actually suffered. It's also due very much to interconnections between markets and what investors are really thinking about the potential of the businesses they're buying. So on the second slide, yes, do I don't know, Chinese buyers or Australian buyers benefit from that situation? And what we see is that similarly to PE, well, nothing actually really changed. We can even maybe see that Italy, or the share of non-Italian buyers in the Italian M&A market, are actually a bit lower than before. But it's, again, very difficult to attribute any significant change to the COVID situation. Moving on to page 8, we get into very interesting, again, a very bizarre observations. We've looked at both stock market valuations and implied multiple, deal implied multiples. And what we see is that deal implied multiples are broadly decreasing slightly. Well, it's difficult to draw any conclusions from the trends. And stock market valuations are at worst stable or have even increased, and they've increased to levels which are higher than transaction multiples. So this is very unusual, and this is also probably what explains in the flurry of IPO activity in the second half of the year. What these multiples don't show is that the market is increasingly polarized between 2 types of businesses. There are a number of businesses, and particularly in the education sector, which is one of the sectors we cover at FDC, where multiples were fairly high pre-COVID, about 11 to 12 or 13 times EBITDA. The deal activity continued unabated during all 2020, and multiples are now probably closer to 14, 15, even 16 for even small businesses. On the other end of the spectrum, our aerospace team got 0 transaction in 2020. Everything stopped. And the industrial team at FDC showed reduced activity, and most of the deals were actually at decreased multiples compared to 2019. So what may explain the situation is that actually the businesses that were transacted were the good ones, and the ones which were the most affected by COVID actually weren't, the deals didn't close, hence this bias towards higher multiples. Now, I think I've got a poll question now. So
you have indeed.
Yeah.
Yeah. So, folks, which sector do you think was affected most positively or negatively by COVID-19? Infrastructure and energy, digital, hospitality, healthcare, and insurance. This is going to be followed by a poll by which sector do you think was least affected. So do remember your answer. But for this one, which sector do you think was most affected, either positively or negatively? And well over half the audience have voted, Emmanuel. I'm just going to leave it open a few seconds. There we go. Vast majority of the audience are going to have a quick close on that one and share the results with people. And our audience, which did get it right, Emmanuel, on the UK being most effective, say it's digital and hospitality in identical proportions. So if that's all right, I will move on to the second poll, which is which sector do you think was least affected, folks? Which sector do you think was least affected? And I'm just launching that poll now. So remember, it was digital and hospitality. And so by definition, I would expect infrastructure and energy or healthcare and insurance. And again, well over half the audience, well over 3/4 of the audience have voted. I'll leave it open just a few more seconds for those of you who are thinking. Okay, and just about to close that one. Great, and share those results. So very much infrastructure and energy. So least affected infrastructure and energy at 77%. Most affected digital and hospitality at a dead equal 40%. Have you got what you need, Emmanuel?
I do, and I think that will make my observations even more interesting. Well, I've been in infrastructure space for the best part of the past 25 years now, and I've been telling my clients and investors in particular that this sector was indeed very resilient, and it proves so. But if you look at airports or toll roads in March or April last year, a lot of people would have thought that, well, the resilience was just not there. So airports were empty, and still what is interesting is that the market didn't crater, and one of the reasons I think is because the debt structures that had been put in place were themselves extremely resilient with long cure periods. And this is probably what ensured the resilience of the equity values. I don't think it was actually an actual flight to quality or to lower risk. I think that there was so much money involved that even the debt remained, and the structures were pretty robust, and that's it. And in my view, this is very different to what happened in other sectors like hospitality, where even the hotels were empty, the debt structures were much more rigid, and the equity values just cratered completely. Healthcare and insurance is an interesting one as well, because it's also very contrasted, and a number of our clients were actually very affected by the regulations or what the government asked. Particularly, if you looked at that in France, all planned non-essential surgeries were cancelled for months and months. So a number of private clinics and hospitals were empty, literally empty. And even though these situations were affected maybe 30 or 40% of the hospital sector, the deals were pretty much there in the same number as the year before. So that in my view was a bit surprising as well. So if we look now at how the valuations held up or not in the infrastructure, we see that indeed it was resilient in number of transactions. But if you look at deal value or transacted value, which we see on page 10, these deal value actually decreased compared to 2019. So we still at, on average, about 10 to 11 times EBITDA. But remember, the education sector, which is now transacting at 14 to 16. So resilience, maybe, but has it been the sector to invest in 2020? Not so sure. Digital, well, unsurprisingly, and I think everyone concurred, digital is the only sector to have benefited from COVID, and multiples even increased during the year. What we saw on the transaction we were working on is that between March and June, the deal continued and pretty much at the same multiples. And after summer, if you wanted to buy a digital business, you had to pay about 2 times more EBITDA. So 15 times is now 17 times. And what used to be 15 times historical numbers are now 17 times current EBITDA. So we're talking of a significant uplift in value for digital businesses. And a number of sectors are actually becoming more digital. One of the reasons I think the education sector performed so well is that all the private schools and private universities moved to digital virtually immediately in March, and now are more sort of digital than sort of traditional businesses. Well, hospitality, very few transactions, no value. I don't think it's worth spending a lot of time on this. And healthcare and insurance also very much reflect this volatility of the businesses. Insurance got virtually unaffected. They even performed very well, since no one actually injured themselves by taking their car, particularly in France, where you can take it from, you can go beyond 1 kilometer from your home. And on the other hand, healthcare, very contrasting, as I said, and also a number of distribution businesses that very often represent a significant proportion of the M&A transaction in that sector simply didn't happen because the logistics and supply chains were completely stopped in some cases or disorganized in others. Few key takeaways, and I think I've managed to do that in just about the right amount of time. Well, in most sectors, asset prices have remained high and are even higher now in 2021 than they were starting 2020. I think that depends both on government support schemes that have prevented liquidity crisis and have virtually always been extended. If you look at what's happening in France at the moment, so you had government support for furloughing schemes. You had government support for social charges. You had quasi-interest-free loans called PGE, guaranteed by the states. These PGEs, which represent, I think, about 100 billion in the economy at the moment, are all being rolled over. And what happens? It's still debt. At some point, you still need some equity as well. So the government is currently introducing a scheme to strengthen the government support scheme to strengthen the equity base of small businesses. And this is going to make our job really difficult in that market for the next 2 years because they are offering 8-year bullet convertible debt at 5 to 6%. So typically, you should be looking at 9 to 11% for this type of instruments. So equity investors are going to struggle, I think, doing deals going forward. Financing is still abundant and cheap, and owners have all been reluctant to adjust their valuation downwards when they had to. Closing deals was very complicated in 2020. I think it's becoming easier in 2021 on different multiples. The deals we're still struggling to close are the ones which were between 6 and 9 times EBITDA pre-COVID. Those are still trading on 6 to 9 times. The complexity is to find on which EBITDA to apply those multiples. Are we looking at, in a way, pro forma 2019 type EBITDAs, or are we looking at historic 2020? 40%. And well, if anyone reading the press, the FT or Les Echos or whatever, will see that there's a growing disconnect between stock market valuation and M&A transaction valuations. So this is going to last, apparently. This is what the market believes. How long is this going to last? This is one of the questions we may ask. And maybe two interrogations, and we don't see anything in numbers yet as regards those 2 points. The first one is that a number of businesses are going to go belly up, and due to the government-sponsored schemes, they're not going under at the moment. In France, the number of liquidation is lower in 2020 than it was in 2019 and 18, so which is quite incredible when you think of it. And also one interrogation is how our lives are going to, professional life, also personal, are going to be affected, and how by COVID. Are we all going to go back to the office and spend a full week at our desk in the city or somewhere? Or are we going to shop at the same shops and the same high streets in the same way as we did before? And I'm part of the people who think that clearly our habits have changed, and clearly this should also have an impact on real estate valuations, particularly the high streets or professional premises. And you don't see that in numbers yet. So let's see what 2021 holds for the real estate sector.
Wow, that was excellent, hey. Emmanuel. Thank you very much for that. Got quite a few questions here, but folks, please do keep them coming in. Really just to kick off, Bob McDowell, he's kind of curious, in what sectors do you think the need to refinance in the sort of emergence from COVID will stimulate M&A?
Ooh, that's a tough one. As long as government supports are still in place, that will, in my view, very much depend on on government politics. France will support, well, that's the message we get, will support businesses whatever the cost. So at some point, support will have to recede at some point. And I suspect that the weakest businesses, particularly in high street, will go under. So this will be a very specific type of M&A, and we see a number of transactions going on as we speak in the retail space, where people are buying a number of portfolio of assets and restructuring the debt underneath them and are redeveloping them. That we see, but because the choice in France was to protect all businesses at high street.
Yeah, I think this medium-term look at the structure of the property component in retail, in commercial, et cetera, is going to really change a lot of valuations. But Hugh Purser is curious. You said, and he quotes you, owners are reluctant to adjust their valuation expectations, even though business plans have changed dramatically. That doesn't seem very realistic. Would you like to comment on that?
Yes. A lot of the work we do is with entrepreneurs and family-owned businesses. And in a way, before I joined FDC, I used to work in large investment banks. And in large investment banks, you work with institutions in a way. The people who sell the businesses are institutions, and they react really, in a way, very reasonably or economically reasonably. Now, when you've spent the best part of the past 25 years or 30 years building up a business, or you've inherited a business constructed by your great-great-grandfather in the 19th century, selling something that represents everything for you or for your family is extremely difficult, even when the values are high. So I think when you thought that your business was worth a lot in 2019 and the value has just dropped like 50%. So it is difficult, and it might not be economically rational, but in the culture the people we deal with, we see a lot of rationality in a way. This is their spending in their own communities that is being, that in some cases, is being under scrutiny here.
Okay. And again, folks, very interested in questions, comments, observations. I'd love to hear from somebody who's thinking about buying and or somebody who's thinking about selling. If you're out there, and if you want to remain anonymous, just indicate that, and I'll keep it so. Emmanuel, Hugh is going on a little bit. He's kind of curious. Are you surprised that there's been no particular flight to quality?
Yes, to be fair, I can't say no. Yes, I am. What I certainly didn't see in early 2020, and what I now perceive, is that maybe the definition of quality has changed. Quality used to be something big and stable and robust, and it's been there for like 3, 4, 5, 6 decades, and it's going to be there for another 5 decades. Now, quality may be more defined as growth business, and any business that has shown or demonstrated growth in 2020 is now probably the new definition of quality. And in that sense, this happened. It's probably why infrastructure that inherently doesn't show a lot of growth wasn't seen as in a way, a safe haven. And but anything that grew is definitely now maybe what can be construed as being the quality business.
I think a number of us are interested in where digital is headed, not least the way FS Club members tend to be quite intensely digital. I'll start with a question from from Mark Heath. Mark is interested in your views on the M&A potential when thinking of improved valuations of intangible digital assets, so data, intellectual property, software processes. Is this disconnect being released when digital assets are valued higher than the goodwill on the balance sheet?
So what we use accounting methods to value businesses extremely rarely, and the amount of goodwill you may have on your balance sheet, especially with regards to IP you may have acquired or anything, actually it's just a minute proportion of our analysis, and most of our analysis rests on discounted cash flows. So if both vendors and acquirers of those businesses believe that the IP will indeed create revenues and EBITDA, then the value will be high, and you will reach high multiples. We may see, and we've seen that once a few years back, a business with a lot of IP acquired through M&A in the past, but that business was unable to develop proper EBITDA out of this IP, and therefore the business wasn't valued that high. So no, we don't look at goodwill, we look at future cash flows.
Now, I know that your analysis was healthcare and insurance, and interestingly, tomorrow we've got Alan Hughes dialing in from Ireland, giving us a lot of detail about the digital care industry. But I've certainly seen a lot of healthcare companies trying to reposition themselves as digital, and I'm sure that's also happening in a lot of other sectors. You know, how much future is there for digital if you can't define it? I mean, everything's got a computer, big deal. What do we look at here? Is digital going to be redefined as much more tightly as being genuine software infrastructure, or is the term going to continue to be abused, or is it just going to be a term we're going to forget about?
Well, digital is certainly a catchword, and was a catchword before COVID. It's what I saw last year is that I've tried to help a number of traditional businesses becoming more digital. One thing is for sure is that they won't be able to do it internally. The cultures you need to move to a proper digital business is just like the one you don't find in traditional businesses. So will M&A enable a traditional business to become a more digital one? Culturally, they've been unable to do a leap of faith in a way. When you're trading at 10 times EBITDA, how do you justify your board that you have to pay 17 or 18 times? And again, this cultural bias or this mentality, traditional mentality, has been very much an impingement to moving to digital. So traditional businesses will have a mix of, call it digital, I don't know how you call it. Everyone does have a computer, and sometimes they will even use them. But digital, in my view, will remain the new businesses that have a proper ERP system. And you can't imagine how old and cumbersome are some of the ERP systems we've seen, even with large customers of ours. Just a new ERP system is something that takes well, depending on how large you are, millions to develop or millions to implement. But it takes 100% of your people to use it. And what we've seen is that not everyone will move into the digital world. So we still see a difference between the digital businesses that will be valued as digital businesses and the one that will pretend to be digital and will still be which will still be valued as traditional businesses.
Well, I'm going to remember that phrase. Everybody's going to have a computer, and sometimes they'll use them. That's a good comment about many of the companies I know. Now, one of the things that was also intriguing was your very first question to us, and then the slide where, okay, we got the answer technically right, but across Europe, everybody was pretty much in lockstep in terms of value and volume. And yet we've had Brexit. Are you seeing any signs of a divergence in the UK market from where it was a year or 2 years ago? Or do you expect this to break, or do you expect it to continue to be largely a European market?
Wow, that's a difficult one. What we certainly feared in the M&A market is that the UK will move away, and that we will lose all our UK clients and UK opportunities. That said, this hasn't happened. So why would it happen now? I don't know. What is for sure is that COVID is not going to change anything to that situation.
Okay, yeah, good, interesting. Bob McDowell is curious as well. He's here. There's a tremendous amount of talk about ESG, environmental, social governance. Do you think this ESG agenda is affecting M&A, and if so, is it encouraging it or inhibiting it?
So a PE friend of mine actually told me that ESG is the new compliance. Mm-hmm. And I think in a way this is there's a lot of box ticking in the PE industry, to be fair. So this, in my view, this is not going to change much, but a number of sectors will find it increasingly difficult to find investors and even lenders. If you look at the oil and gas industry, where a number of sectors are already struggling to get financing, this is one. Others might be like steel making as well. So I don't think that ESG criteria per se are going to be the difficulty there or the constraint there. However, the general changes or societal changes is going to be important.
Now, obviously, everybody wants the hot tips. So, looking forward, where do you see the hot sectors for 2021 second half and first half of 2022?
Well, you're going to hate me. I don't have any crystal ball here, but I suspect that digital is probably where you want to be, it is not because it just has SaaS or digital words attached to that sector. It's also because returns in the PE industry for traditional businesses have dropped considerably. So if you KKR or Advent International or CVC or Simon or whomever, and you want to deliver 25% to your shareholders, just almost there's no way to do it with traditional businesses. And this is why they are all creating what they call capital or growth capital or development capital units that will invest in digital businesses, that will show these 50% per annum growth that everyone is seeking. And therefore, this, in my view, this is going to drive the market even higher, the digital market even higher.
And when I look at this and going forward, I'm a little surprised, and maybe you'll correct me, but the real change to me has been the change in the property sector. Here in London, we've been seeing void rates increase in the city at about 0.5% a month. It was about, I think, 6.5%, 7% at the beginning of the pandemic, and it's now running around 13.5%, 14%. Broadly, as leases come up, they're being cancelled in a reasonably high percentage. I assume that's going on, really across Europe, and that should be flowing through, by and large, to the bottom line of the folks in digital hospitality and healthcare, but also, of course, negatively affecting large commercial property owners. Is this going to be a transient adjustment, or do you think it's potentially a permanent adjustment?
Well, I think there's this particular market is very much as the crossroads of many societal trends. If you look at the high street market, it's going to behave very differently, in my view, than the residential market. And it's going to react again very differently to the professional market or commercial centers. The commercial market, it turns out that we actually moving offices in 6 months' time. The rent is exactly the same as before, even a bit higher. But in France, you're going to get the catch. In France, you actually, as a business, you are committed to 3, 6, or 9 years. And okay, the lease rate is exactly the same, and we're going to get 18 months free rent. So, so there's a disconnect between what you see reported in indices and what the market is actually witnesses at the moment. And since there are very few real estate transactions, this hasn't translated yet through the bottom line to the bottom line of the real estate businesses. And there are also a number of things that are happening that may actually compensate partly this situation. A lot of people are working on co-working, co-living concepts, whereby you may have at the same place where you had, let's say, 1 apartment, you'll have 3 studios that are going to be shared. Everyone will be paying a bit more than if they were renting a studio, or a bit less if they were renting a studios, but overall, as an owner, you will get more rent. And we see a lot of concept being developed where the uses are increasingly mixed. And basically, the idea is to make the usage more intensive than before. So maybe we get to the situation individual clients will pay less for the rent, but the owner, by a more intensive use of the real estate space, will actually get more revenues from that. So let's see where the jury's out, let's say. We'll see in a few years. It's not going to happen overnight.
Yeah, it's interesting. I was picking up a report yesterday here on the London market, and it said that traditionally the very top class of office quality space would be seen by about 35% of potential buyers. And actually the bookings to view those are up about 50%. So people are looking, and they're prepared to pay, and they're even prepared to pay, for the top quality bit. and yet the leases are being rolled off as well. So a real change there in what commercial users expect. Well, we could go on for hours, I know, Emmanuel, and I think what's been great today is your sound quality has been super, although the video's kind of faded in and out a few times. So
Okay.
we've picked up everything, and the slides were excellent, and your research was super. And if you don't mind, as ever, I'm going to have to call it quits as people are thanking, but I'll just, if I may, make 3 quick rounds of thanks. Firstly, as ever, to our sponsors. The challenges of M&A, the dog-eat-dog world that leads to Schumpeterian, creative destruction is out there, and one that it's really fascinating to take a look at in such a volatile year, and yet maybe not such a volatile year. I'd like to thank you, the audience, as ever, for coming. As I mentioned, tomorrow we'll be looking in depth at digital healthcare with an Irish perspective. But as ever, please do go to the website and see what's there. There's a rich feast of events available for FS Club members. But finally, and most importantly, Emmanuel, I'd like to thank you. You've done a tremendous amount of work to really give us some solid depth in these areas, and I found it absolutely thrilling. And I look forward to you and FDC raging and rampaging across the European M&A landscape and telling us what you find, because it helps, I think, to inform a lot of decisions out here. So thank you very much. Unfortunately, I can't give you a digital solution to online applause that works at all, but I do have a non-digital analog solution, which is my Korean karmic clapper. And I'm afraid that will have to do as applause. But we'd love to have you back with your views as the market evolves, perhaps next year. So thank you very, very much for coming.
Thank you very much, Michael, for hosting.